Welcome to the Ralph Bivins Project. My name's Ralph Bivins. We're here today to talk about changes going on in our world and in our marketplace, and then especially in office buildings, which are undergoing tremendous transformation right now with the work from home thing during the coronavirus pandemic we've had has changed everything. You may be working from home now. You may be going to the office a little bit. Your company may be talking about what happens next. And we know it, people that work in restaurants in downtown, particularly those guys are hurting because they don't have any lunch business or other business. It's pretty phenomenal. It's been devastating to some. In Houston, as you know, office market's been particularly hard hit because the changes in the office, the oil business, and a lot of vacancy. Right now, Houston has more office vacancy than any other city in North America. And we're going to try to talk about that and think about that and see where are we going, what's next. So who better to talk to? And I'm really privileged today to have Bill Brownfield here. He's been in the business since 1979. He currently has a company called Alpha Office Escalations, which helps property managers with dealing with their expenses and things. But he also has been, director of acquisitions for Means NOS for a number of years. And as we know, Doug Noss's reputation is, one of the best in the business, definitely. Yeah. And so he's tremendous. He'd been with Paragon from a long time ago. Paragon Real Estate, they were a big player in Texas, and he's been elsewhere on property management side, acquisition side, leasing side. Bill is pretty much an expert. So thank you, Bill, for being here.
Thank you, Ralph, very much for having me.
Yeah. What do you think? How would you describe the market right now? Where are we at, and what's the state of affairs?
It's probably best to start with some of the basics, and the easy definition of the problem is that it's a supply-demand issue with the emphasis on demand, meaning that we have slack demand, lack of demand, and it's driven by three primary themes that you've already touched on. And in terms of sequence and importance and how they impacted the market, I think the oil and gas recession should be mentioned first. I read this morning that for the month of March 2021, that gasoline sales nationally were 10% higher than March of 2020. So that's a good sign, and potentially an indicator that we bottomed out, and maybe that particular theme could be easing somewhat. The second theme that you mentioned is the COVID vacancy impact. I've got a chart here. I probably can't show much on this, but this is a chart that Del Kendall with RERC provided to me in December, and it's something that Castle Systems created. You might remember them as the access control company, and they're nationwide.
Well,
I'm going to try and hold this up. Yeah, just look at it. It's very eye-popping and dramatic.
Ooh, you can see.
Yeah, it's a clip. Yeah.
Fall off. And I guess that's the Castle's kind of measures, what day-to-day actual occupancy in the building there, how many people
head count. Yeah, it's real head count, and it's to be differentiated from leasing occupancy or leasing percentage, right? And so that chart that I just showed reflects 10 major markets that they've tracked, ranging from New York to San Francisco to Dallas, Houston, and a number of other markets in between, like Chicago and so on. The main theme is that in January and February, all of those markets were 90% or above. Houston probably a little bit below that at the time. And by middle of March, everything dropped off a cliff. And it's like 10 ropes, different colors, hanging off the side of a cliff.
Nobody
And
was coming into the office.
right, yeah, everybody hit bottom, and New York bottomed out below 5% headcount occupancy, um, and other cities stacked a little bit higher than that. Houston and Dallas were at about 10%, maybe 11%, and then as you move across the year through across the months, you see a gradual increase in all of those. Very gradual in New York. They're still around 10%, right? It's still really very dramatic for them. Focusing on Texas, Dallas is mid to high 30s. This is for Castle's numbers, and probably around 35, 36% for Houston, again for Castle.
So what was the percentage on Houston again? I'm sorry.
I would say Houston's 35, 36% for Castle. But if you talk to our client base, and they're national, right, for our escalation software, what they're dealing with are really dramatic gross ups on the average of about 20% occupancy, okay? And I think that's fairly reflective of where overall Houston is, somewhere between 20 and 25%. I do expect that to ease up, though. I mean, we're approaching, they say, herd immunity. And so I think it's going to be possible for a lot of businesses to at least have the option to reopen their offices later this year. I don't know if that's 2 months or this summer or if it's in the fall, but most likely, I guess, is in the summer. So of the three themes, those two seem to be capable of being described as bottoming out and potentially easing somewhat, especially over time. The third one, though, the one that you mentioned, is the work from home angle that a lot of people have, including you, including me, that we've dealt with over the last year as well. And I think that's going to have a longer impact. It's going to take a lot longer to really understand the full impact of that particular theme for everybody. If you wanted me to put a time frame, it's dangerous to do that, but if you wanted me to put a time frame on, yeah, I'll give you two time frames. Okay. I think it's going to take probably 2 years for us to bottom out completely. And if you look at February of 2020, average vacancy was on the order of 22%. You fast forward to February and March of 2021, that number has moved up to the high 20s, right? Maybe 28, maybe 30%. Nobody really knows exactly. And that number does not include sublease space. I talked with Henry Hagendorf yesterday, and I called him because I knew that he hosted he was the moderator of the office sector of the CCIM forecast about a week ago, and his takeaway from that is that we're clearly in the high 20s, potentially, up to as much as 30% vacancy, excluding sublease space. Now you layer on top of that, and here's why I have a 2-year bottoming out scenario. We have, I would guess, and that's what it is, a natural lease rollover, expiration of leases on the order of probably 12% to 15% per year, right? If you assume that everybody is a 5-year lease, that means 20%. But I think we can go with a lower number than 20%. So if you run with 12% to 15%, and you assume that some portion of those are going to not renew completely, maybe they're going to downsize, maybe they're going to vacate completely, that's the order of 6 to 7 to 8% that could get added to the numbers that I was just talking about 30%, right? And add the sublease space in there because that will eventually expire as well. So I think that for the next 2 years, we could be looking well into the 30s in terms of overall vacancy. I don't really want to extrapolate out beyond 2 years because that's, who really knows? But I think the numbers that we've just talked about are fairly reliable and indicative of what could happen. Once we hit bottom, I think it could take 3 years to 5 years for us to climb out and then reach some degree of stabilization. And all of that regrowth or backfilling has got to happen from job growth and population growth. And I do feel very positive about that. I mean, Texas, as everybody knows, is a great recipient of in-migration. And as long as Houston leadership, and I'm talking city, county, Greater Houston Partnership, as long as they are successful in their efforts to bring new businesses into Houston, then I think that will contribute to that ramping back up beginning.
That would be pretty handy to have a few big hits in the office relocations and some more headquarters coming here.
Exactly. It implies that the strategy, so maybe this is the next bumper sticker that we see out there, is survive till 2025.
Survive till 2024. We'll mark that down. We'll make note of it.
Yeah.
First here.
That would be my bet at the moment.
Project right there. We got it. Boy, that's a historical marker for us. 2025. Yeah, that sounds likely. I'm thinking, I don't know what it is, but you would think these companies whose leases are coming up and maybe they had 10 floors they had been occupying, and they said, well, now we've got so many people working from home, well, we're going to cut that back to 6 floors, or maybe we're going to cut it back to 4 floors, or if you're going to go from 70,000 square feet of office that your company's in, and you're going to cut that back to 40. And so boom, you got 30,000 square feet vacant here and there, and it's all over the city. Continues.
I think there are tons of conversations like that going on right now. Another comment that Henry made yesterday was that he's experiencing this wait and see attitude by a number of tenants. And that seems to be a reasonable theme until people really understand, until decision makers really understand how well they can run their businesses off-site, decentralized, spread out. I don't think they'll know how much office space they want. So it means that they're going to want a lot of flexibility. Let's say that over the next 12 months, 12%, 15% of those companies are facing a decision where they have to make that decision. And that's excluding the ones that are making the decision now to cut back early or whatever they're doing. But let's say that that natural rollover of leases, that those CEOs, those decision makers are going to be forced to make some decision. And I think what they'll ask for naturally is some flexibility, right? They'll look for early termination rights or expansion rights even, and because it's going to take them a while to figure out if this team collaboration seems to be the big theme for those saying that office will come back, right? That you get better results, but I think that's a company by company conversation, company by company decision. And there are a lot of variables that come to play in it. One is what percentage of their overhead, what percentage of their operating costs are related to rent. If it's a big number, many of them I think are going to be compelled to use a work from home strategy to some extent. If it's a small number, like an Amazon, where it's a drop in the bucket, it's not going to mean much to them. Right.
I've read about Google doing major expansion, and Amazon, all these places that say we it's not an issue for them because it's such a small, how much they spend on rent. It's small line item for them.
Right. It's much less important to those bigger companies than some of the other issues that they have. For example, I have no clue what Amazon's real estate budget is, but if you break it down between office and industrial, I would bet that industrial accounts for 90% or more of their budget. So
they're opening every time you turn around. Amazon's open. Last week, Amazon, we're going to open 4 small things here in Houston. Small, right. What do you mean? Well, it's between 150,000 to 300,000 square feet of warehouse. 4 of them all at once. They're opening all these things all over America.
Yep. Glad you're coming.
That's the other thing. Retail is going online too. That's been a big pandemic result.
I agree. One of the topics maybe worth talking about, since you and I go back so many decades, is to answer the question that some people are asking, and that is, hey, is this going to be like the 80s? And my short answer to that is no. I think that the economic structure of Houston's economy is so different now than then. And so is the ownership of office buildings in general, commercial real estate in general. There's so much more institutional ownership today, and that institutional ownership, that's pension fund money, it's REITs, and pension funds. I think I mentioned that, but the point is that they have the deeper pockets than the office building owners did in the 80s. And they have larger portfolios to spread this pain across. And so I think, they're going to be
these more smaller entrepreneurial developer owners than instead of the big institutions.
Yes. Yeah. And what I anticipate happening, and I think it's partly underway, is a bifurcation within the marketplace of two categories. First by class, meaning AA's. I think they're going to do fine because of the amenities that they can offer, and there's a certain type of tenant that wants to be in that and needs to be in a AA type property in order to convey the proper image for employees they're trying to attract and keep. The other bucket is A's and B's, your traditional A's and B's. And I think they're going to have to compete much like commodity space. They'll be beating each other up. A's will be spending money on CapEx improvements to try and compete or get closer to the AA's. And many of the B owners won't be able to do that. But so nonetheless, I think as a category, they're going to compete on price and concessions and so on. And then the third bucket is Class C. And I think we're going to see those in many cases disappear, fall off the chart through different ways. One would be through conversions. There was an article yesterday in the Houston Business Journal about one of the older, I think 1920s era office buildings downtown on Main Street being converted to a Marriott, which I think is a great example of what can happen to other Class C properties as well. So, so that's bifurcating by class, right? But I think there's also going to be a bifurcation by type of ownership. I mentioned the REITs and institutional owners. They're going to be in a much stronger position to maybe not hold rents completely, but to decrease rents and give fewer concessions than others. And then you have the private ownership that you referred to, the other investor types and I think they're the ones who are going to have a lot of difficulty. The institutional owners, they have very inexpensive debt. Private capital eventually has to talk to their banks, right? Yeah. So I think they're going to have a lot less flexibility with what happens. So, from a strategy standpoint, I'm sure many of them are already in those conversations, looking at their lease rollover schedules, looking at what and how they fit into their particular sub-market, what their likely occupancy is going to be in 1 year, 2 years, 3 years, and trying to deal with that, especially since we're in a low interest environment. I think they should be in those conversations.
It's I believe that you worked for a while on a national level with the Equity Office, which
yes,
that's Sam Zell's organization, is it not?
Correct. Right.
And Sam Zell, for people that historically speaking, he is an expert in distressed properties of all sorts. He knows he's got the skill to really find those distressed assets, get the right price, and know when to pull the trigger.
Right. His moniker back in the 70s and 80s was the grave dancer.
The grave dancer.
Yeah, because he would go in and
Yeah.
find undervalued, undermanaged properties, bring expertise and money to them, and fix them up. And he was really terrific with that, and he was terrific with buying office buildings. And during the outflow of assets from the RTC days, in the early 90s. The other thing worth mentioning is that REITs didn't exist back in the 1980s. Okay, they some mortgage REITs did, but these equity REITs, they really came to play in great part because of Sam Zell creating several REITs for office and apartments and so on in the early 90s, including equity office.
What does what with the grave dancer? He's looking around. He knows what's going on. Really, he knows that obviously hotels are they're probably at rock bottom prices right now. They're getting close. He knows what's going on in every property type. But I wonder what Zell, the great grave dancer's, thinking about the office market right now. Is he thinking, is there deals to move in, or are they just, Class C is not really worth something he would give a damn about?
Yeah, I learned a long time ago not to imagine that I could think like Sam Zell. So I will avoid speculating about that. But one thing I feel pretty confident about is that he's probably very happy that he sold equity office, and doesn't own office. I think he does have a few office investments that he picked up several years ago, but it's not a major theme for him today that I'm aware of. I have not checked in recent years, but I just, I think it's an asset class.
The other guys right now, what about, like Boxer and guys like that? What do you this other people that are other companies that are pretty adept at finding distressed assets? What do you think what's going to be happening with them? Are they looking right now? Are they thinking this is?
I don't know the answer to that. If they have capital, I'm sure they're teeing up to expand their portfolios. But they may be redirecting that capital to other asset classes right now, Ralph. I really don't know. But I think it will be a good time for that type of investor. Things look really negative right now. One of the things that I also wanted to point out, I'm going to hold this up as well, and right. It's everybody knows about the real estate cycle.
We can do it.
Yeah, thank you. Everybody knows about the real estate cycle. You have an up leg, and then you have a peak, and then you have a down leg, right. And you have a bottom, and then it repeats itself kind of over and over again. That's the basic design of the cycle. Well, there is a cycle of market emotions that accompany those stages along the cycle. And I really think it's important that people gear themselves up for what those various stages are. And I'll read some of them in a minute. But this is something you can find on the internet, and it's called it's called.
I'm backing up a little bit towards you, just like a couple inches now. Okay. Now what do we got?
It's called the cycle of market emotions. And there are 7 steps to the upside. There are 8 stages to the downside. Let me read a couple of the downside ones. I think this is
about emotions. It's about emotions.
This is emotions associated with different stages in the cycle. Okay,
well,
and you can Google this and put it on your desk, because I think people are going to need some reinforcement for what they go through over the next couple of years. But the first stage is anxiety. The second is denial. The third is fear. I think that's where we are today. The fourth is desperation, meaning you're still going down and you're thinking, my God, how long is this going to go? Number 5 is panic. Number 6 is capitulation, where you acknowledge, God, yeah, I get it. The 7th is despondency, meaning there's nothing I can do about it. And the 8th is depression. And then it starts turning up to the upside. There's hope and so on. And it all starts again. So, but this, by the way, was created for an explanation of stock market cycles. And it is very applicable to the real estate cycle as well. And we talked about Doug Noss a minute ago, and I remember back in the mid '80s, having conversations with him and Steve Means about getting out of the denial phase, right? And moving on to the others where we just accepted what was going on. Another interesting factoid about the '80s that I do not think we will see again. We were doing at the bottom of that cycle, we were doing negative NPV deals, right? And I won't get into an explanation of that, but the leasing people that listen to this and the owners that listen to this will know exactly what that's about, right? It means that you're losing money on every deal, every lease you sign. And we took it down to a negative $2.50 a foot on our deals. And the reason that we did that was because we were at least paying operating expenses, which was a benefit to the owners, right? If that lease was not done, they would have lost another $4 to $6 per square foot.
Cool.
So anyway,
I do not remember that. You remember Harold Farm? He has on San Felipe over the big.
Well, we bought it at Equity Office.
Yeah, I remember he told me I'm losing $1 million a day, on that.
Yes.
When you put it in those terms, you go, wow. Of course, that made a big headline for me, and it, Farr was pretty much a well-known socialite as well as it.
Yeah, absolutely.
Losing $1 million a day, they're going.
I have to tell you, he built a beautiful building. San Felipe Plaza was used the best materials when it was built. It was a phenomenal project that he built. And the story at the time was that during construction, he was selling an apartment complex a month in order to pay for it, because he paid cash. He didn't use any debt for it. But it's still a phenomenal project today. And he deserves the credit for that, and so does Equity Office and subsequent owners that have continued to maintain it so well.
Yeah, that's amazing. That's amazing. Hey, I know you also. When was it? Let me look at your 82 to 86. You were, head of the Cullen Center, managing that property, making it happen, and everything. Big downtown office complex with several buildings, and that's and of course, I guess for my subscribers, to Realty News Report and the R&R newsletter, keep coming. We enjoy having the readership. But if you've read that recently, that I guess it's 600 Jefferson, which is now called, they turned the address around to another side of the building, make it 1801 Smith. It was just purchased by John Quinlan, and he just got it. I believe it's 20.6 million for 20 stories, 458,000 square feet.
$45 a foot is what your article said, if I remember correctly.
Well, how's that price strike you? 40. That may have been what you were doing back in 1982 or something, or less than that. I don't know. But what do you think about what Quinlan did?
I think it's smart. I think that he'll be able to offer rental rates that are significantly below his direct competition, and it's just a matter of finding the right tenants. Now, the DRA Advisors, I think, was the seller, and and I interacted with them a little bit when they purchased it years ago, and so I had a little bit of an understanding about what their objectives were, and the bank was still in there at the time, if I remember correctly. Yeah, Cullen Bank, and they were not able to backfill for Continental's backroom office operations that was in the building as well. I think that was ultimately probably what compelled them to sell, although they're a private equity group as well, DRA is, and they probably were bumping up against the fund's time frame, and that may have driven their decision as well. So
when Continental or United Airlines moved out and moved to Heinz Building on Main Street there, that was a blow to Cullen Center. And I'm looking at it. I drove down there is, oh man. And you got the Whitehall Hotel that
Yep, it's
is
terrific.
still there, and you think, well, that's. But we also talked about in my column about just the potential for the southern part of downtown to get a real boost, a real awakening from the plan for TxDOT program, which will tear down the Pierce Elevated and potentially replace that acreage that's underneath the freeway right now with parkland, green space that could be a real, I think, for guys like John Quinlan, other owners that are nearby the Pierce right now, that could be a real boost. And we've seen what's happened in, I guess, in Dallas with, the Clyde Warren, all that, and that way John Goff pulled that off with developing a park on top of a freeway that's depressed. And you look at it now, and it was, like bank drive-ins and, just kind of
it's amazing.
Nothing. And now you got high rises. I don't know, you could be, 700, a million or a billion, or I don't know, but there are a lot of high rises around it. Families playing in the park every weekend. It was a brilliant transformation that, it could happen here. I know there are hurdles, but it could happen here, and it could really improve some of these downtown.
Well, I think you're really onto something, and I really, it's terrific that you're continuing to beat that drum and to continue to bring it up, because I think it'll have an enormous impact on the southern part of downtown. It's good for the city. It means higher property taxes will be collected by the city and the county, and the schools.
The schools. It's kind of takes a few steps and some big picture, but when you're talking about creating that much property tax value that can help all these governments, and then you go from thinking about, well, there may be some rough spots up front, but if you have really good funding that the government and these governmental entities can use for improving schools or improving parkland or whatever our city needs, transportation, everything, it could have some major benefits when you're throwing off so much property tax value a year just from just from the Pierce alone. Pierce elevated, the removal of Pierce Elevated alone could generate a ton of property tax values, and that's good. And we also, before I forget, my new trial balloon in that column was, let's call, the south part of downtown Soho, which has a lot of cliche to it, but it's got a lot of good stuff to it. Soho, which south part of it, reminds me of like Lodo in Denver, lower downtown in Denver. Let's make it a place. And, that can be promotable. And
I'm familiar with Lodo in Denver. We bought property in downtown Denver, office buildings, when I was at Means Nos, and it's the transformation of that part of Denver has really been dramatic, and I think the same thing could happen in Houston as well. And the transition between downtown and the area Midtown just to the south, I think it's important that it be an attractive transition, and getting rid of that elevated area and everything associated with it, I think will lend to that. My recollection is that back in the early 1900s, Midtown was kind of the River Oaks of its time. There's still a mansion there. I don't know who owns it now, but
the Kirby Mansion.
I think it is the Kirby Mansion, and it's fairly indicative of what used to be there. Yeah.
That's a beautiful building. It could be a lot.
Yeah, absolutely. So, I don't know how we're doing on time, but in terms of a recovery, if you want to shift to a conversation about that,
Sure.
I'm reminded of the Wall Street movie where Gordon Gekko's famous saying was, "Greed is good."
Yeah.
I think he got it wrong. I've always felt that. I think that the right way to say it is that growth is good, and Houston is a great example of that. You know, we've had phenomenal growth over the years. I think we'll continue to have really good growth. We're just going to be in a tough spot for a couple of years until that growth adds to the population and to the job base. And so I think the recovery is going to be dependent upon the city continuing to attract new companies here, new businesses. I think that they need to have an emphasis on technology, and the city and county and Greater Houston Partnership, I think they're all focused on the right things. I just hope that we get our fair share of businesses moving to Texas, and I know they're working hard to make that happen. The other part of I mentioned we have a demand problem, right? The other part of the demand problem is to eliminate some of the inventory. And that is where some of the lower Cs can be shifted over into other uses through conversions, or even tearing them down and reusing the land for something else. And I think that's a constant thing, the churning that has to happen in any thriving real estate market. And we just need to really pay attention to that part of the supply and demand formula right now.
Dallas has done a pretty phenomenal job in
downtown,
downtown, and I think you can probably Google it, but I wrote a story for Urban Land magazine with the ULI about downtown Dallas. Now they converted a number of buildings to purposes like apartments, hotels, and things, and they had massive office downtown. Elsewhere.
Dallas has some real unique issues, and I think they've dealt with them adequately. But some of the issues are structural, meaning if you look at a map, the suburbs, unlike Houston, are separately incorporated communities, right? All the way up Preston, all the way to the north, and each of those communities has a new business manager, if you will, or somebody looking to grow their tax base, right? And so when tenants downtown get close to expiring, you've got probably 10 different communities chasing them, trying to give them incentives to get them to move out of downtown. So I think that contributed over the years to some of the decline in office properties there. That's just me making stuff up, but just based on my experience and looking at assets there, trying to buy years ago the KPMG building in downtown Dallas, and other assets there. They had some incredible downtown assets, but they probably have some of the lowest rents of many of the submarkets in Dallas now. So it needs to be thought through, and for Houston, we've got such a large area. I think that's controlled by a couple of entities, and so I think we'll have a little bit. I don't know if easier time is the right way to say it, but we can come up with some different solutions maybe than what Dallas had.
That's right, and we do have the small communities like West University Place and Bel Air, but they will not be in favor of a high-rise tower.
Correct.
They will. That's not going to happen. They will hardly let any kind of multifamily project.
Right.
So much less any commercial development carefully controlled.
Agreed. Yeah, that's a big difference.
But anyway, I forgot to mention that Bill wrote a book called The Escalation Handbook for Office Buildings. Okay, you can probably find that online somewhere, or just give
BOMA.org.
Well, there you go. Okay, but that's but you might want to check it out. But anyway, Bill, I feel, I think there is hope. As we're your chart about the decline in the emotions, was very telling, and I do think, I know our newsletter came out and said March 1st, we published March 1st. That's the bottom. That we're all in all, on all markets and just the economy, everything. It's not going to get any worse than that. It started to turn upward, and it has. I mean, but this one exception of the lingering impact on the office market may be an exception to that. The things are getting better. We could have a few rocky bottoms here before we get out and get back on the highway. That we shall see. But I appreciate you sharing your tremendous experience and wisdom and knowledge with us today, and we will hope you can come back sometime.
Thank you, Ralph. Really appreciate the time, and always enjoy talking with you.
Thank you.